Welcome back to the Everything Property Podcast. Today we've got a really fun episode planned. If you might remember, for those of you who've been listening for a couple of months now, we got Jordan de Jong from Game Plans on, and then we launched the competition after that episode to build live in the Everything Property recording studio a member of our community's portfolio live on air. I'm sitting with Alanah Pilcher from Melbourne, who has been flown in today to build her podcast live on air. So I'm really excited to join it. We've also got Jordy from the Gold Coast on team. So those of you that are watching on YouTube, you'll be able to see Jordy's face. And we're also going to do a screen recording of the portfolio building live. So I'm hoping that this will be some great value. And if anyone out there that is listening can relate to Alana and her circumstances, maybe you get some value from this too. But Alana, welcome.
Thank you for having me.
That's all right. Thanks for coming into Sydney.
I'm excited.
A little bit slightly maybe warmer than Melbourne.
Yes, you could definitely say that.
Yeah, but I guess when as I said just before we started, when I have people on that I know or that I can research, you know, I'll listen to podcasts on them. I'll do a read up and stuff like that. But apart from sort of a couple of pics on Instagram, I don't really know too much about you. So tell the guests who you are, what you do, and where you're at in your property journey.
Okay, so I work for a logistics company where I oversee like the operations department for the company. So we work in freight forwarding, customs clearance, imports and exports, the whole shebang. And at the moment, I currently have two properties, one that I live in and one that I rent.
Okay, and why? Tell me a little bit about coming out of school, and I know you've been doing that for a very long time. So what was your journey in high school, coming out, finding a job versus uni and tertiary education? What was that sort of like for you?
So for when I was finishing high school, I had no idea what I wanted to do. I was stuck. Nothing really grabbed me, sort of thing. So I just went into a business degree and just sort of thought I would figure sort of something out and see how I go. And I did not like uni. I didn't go to class. I didn't. I would go to the shops instead of going to class. I put it off as much as I could. And then my parents said, why don't you come in and just help out for the summer? Mm-hmm. And I haven't left.
Wow. Okay, so it's your parents' biz. You've been working for them for the last 10 years.
Yeah. I was, almost 10 years. I was 19 when I started there.
And you're still enjoying it and it's still all right?
Yeah, every day is different, which is so good.
Okay, and that's your 9 to 5?
Yes, correct.
You may have also let sneak that there's another job in amongst there somewhere?
Yeah.
So tell me.
I work a couple of part-time jobs.
Yeah. So you got the 9 to 5?
Yep.
You're working a couple of
just small part-time jobs.
Okay, tell me about them. I like this. This is grind.
So I work for a rental compliance company. So I don't know if they have it in Sydney, but I know they have it in Melbourne, where you have to have your electrical compliance done and your gas compliance and your smoke alarms checked.
Yep.
It's like part of the government. Mm-hmm. So I just arrange bookings with tenants and stuff like that to get those things compliant and up to date.
Yep.
Yeah, and then my other part-time job.
When do you do that? Where do you find the time?
You find the time.
Okay,
if you need to, you find the time.
Fair, yeah.
And then other than that, I just have a couple of small cleaning jobs that I do.
Wow. And why do you feel you need to do those other jobs?
Cash flow.
Cash flow?
Yeah.
Okay. And and tell me a little bit about your current two properties, if you want to reveal locations, values, that kind of stuff.
So they're both in Melbourne. So my first one that I rent out, I bought that when I was about 21.
21?
Yeah.
Shit, okay.
So when I bought that, I still lived at home and everything. So I've only just recently sort of moved out. Mm-hmm. And that was when I built the second one.
Okay. And that first one that you built, what was the first one that you bought? Often a lot of people I talk to and tell them is that first one's always the hardest.
Yeah.
So talk to me a little bit about how much was it? How much did you have to save? You know, were you able to leverage any of the government schemes or anything like that, or?
So I'm pretty sure when I bought that, they have now like a stamp duty sort of thing. If it's under a certain amount, you don't
concession.
pay. Yeah. So when I bought that, they didn't have that in motion yet. So I did pay the stamp duty and everything on it. But I guess because I was so young, I also didn't really know about any of that. Like I had no idea that I had to pay these extra things and conveyances and all of that. Yeah. So it was a really big learning curve. Yeah.
What was the price?
I bought it for $550.
And you 10% deposit, so you're in about 60, 75 grand or something.
I think I had about 10%. Yeah.
Wow.
Yeah.
At 21, you've done well.
Yeah. I've had a job since I was like 15, so I guess.
All that savings. All right, and you've got a couple of part-time jobs.
Yeah.
Perfect. So you've got that under the way, and what about the new one that you've just built?
So I bought the land throughout COVID.
Yep.
And then it was finished being built August last year. So then I moved in.
And you moved in. You live there by yourself?
No, I have a family member that also lives there with me.
Okay, perfect. Yeah. Where's that?
It's called Fraser Rise.
Fraser Rise, okay.
Yeah.
Well, give me, if there's people that aren't the best at navigating Melbourne, where would I say that is?
I would say more towards airport.
Okay, more towards airport.
Yeah.
Perfect. And you're living in there, and
yep.
Jordy, that's probably a good little recap and setup with Alana. Would you agree?
Yeah, 100%. I think, firstly, well done for getting in at 21. Like, there's not a lot of people that say that they can get in at 21. Like, that's crazy. And had a little chat to Alana yesterday about some values and everything now, and she's got a fair bit of equity in there. So to be as young as you are, to have that equity available is such a big win. So hats off to you.
Thank you.
Yeah, you and how old are you now?
I'm 28.
28 now, 2 properties under the belt. Just before this episode, what we got Jordy to do was reach out to Alana, a little bit of questionnaire, captured a little bit of detail, but what's your thoughts? What's your plans around property? What do you want to do with this? Where do you want to take it? Is it 3, 5, 50? You know, what do you want to do?
To be honest, I just want to do as much as I can at the end of the day. That's pretty much it. I don't have a set number that I
passive income goal or anything like that?
No, I just want to be able to live and, make some sort of good choices and good investments.
All right. Jordy, it's over to you, my friend. So tell me what we've done and how we've set this up.
I like it. It's cool. So we've got the 2 properties in the system, and we can take a quick look into just some growth numbers since she's purchased it. So this first one we purchased back in 2016 for around $560. Current value, we reckon roughly is about $850.
$850?
Which means she's had 51% growth since she's purchased and about a 5.4% compound growth rate. Now, the Australian average is about 6.8. So it is a little bit under the Australian average. But the good news is, Melbourne really hasn't performed since COVID. So a lot of people are speaking about Melbourne, needing to catch up to the mean reversion at the moment. Mm-hmm. So the good thing is we do have some really good growth in there. With the equity that we've got that we could potentially extract, the total is 387, and then borrowable equity is around 217. Wow. So, the good news here is we've got some cash available that we could potentially extract to go again. And same for property number 2. Finished building in 2023. Purchase price was around 600. Current value is around 750, which again is about 25% growth.
House and land package for 600?
I did it separately, so I picked the house and everything.
Wow,
yeah.
That's cheap. Yeah. What was the land price out of that?
I think it was 300.
Wow. Okay.
Yeah, 350.
It's cheap down in Melbourne. That's like a build price in honestly build price in Southwest Sydney. There's people paying 600,000-800,000 just for the house. Mm. So to get a house and land package at 600, that's amazing. Yep. Let's go. Sorry, Jordy.
You've done really well. No, it's good. And that's 25% growth in a year is phenomenal. That gives you a lower LVR. You've got 290 grand worth of equity in that asset, and then you can extract about 140 of that at an 80% LVR, which again, in terms of total borrowable equity, we're up to the 500K mark, which is a lot that you can potentially extract. But
Alana,
the best thing about
4 to 500K of borrowable equity, this is
at 28 is pretty phenomenal.
Yeah, that is honestly crazy.
But the best thing about Alana's story and kind of where she's at, and it's the perfect portfolio to plan out, because a lot of people will resonate with where she's at. Now, given the current income levels, we're kind of maxed out, right? Like with those two assets, even though we've got all this borrowable equity that's available to us, we are kind of maxed out in terms of what we can borrow and do with the portfolio moving forward. Now, obviously, times will change, incomes will change. Maybe the family will grow over time. And I had to ask Alana that awkward question yesterday if she's looking to get a partner at some point in time. But that secondary source of income will come in at some point in time, which is a really, really good thing. But there are definitely a few things that we can do in the short term or the interim to either be super aggressive and continue to build out the portfolio, or we can sit on our hands, wait till, the economy gets a little bit better, maybe we're a little bit more flexible in terms of what we can borrow, and then continue investing from there. So, we can build out a plan live if you guys want to.
Yeah, 100%.
Awesome. So, I think just given where we're at right now, with our passive income, Alana, when she first put it in, said she had a target of $1 million worth of passive income, which I think is super good. But we brought that down to a realistic number of about 100 grand.
Nah, what do you wish? She wants $1 million, George.
She can definitely do it, but
I'm putting a few things together here. Wasn't at uni, was going shopping. Wants the $1 million passive per year. We can start to see what type of gal she is. All right, perfect. Sorry.
Bait the picture. I like it. Cool. Which means even over 30 years, if we can get to 200K, you're going to replace our current income, which is awesome. Given the current portfolio, we are a little bit negative just because we got one of the principal place of residence in there. So it's costing us around 55 grand a year, including our living circumstance, which is awesome. Mm-hmm. The cool thing is though, once those loans actually do get paid off, the final one gets paid off in 2045, and she starts to generate around 62K worth of passive income, which if we have a look visually on the chart here, it's kind of like, 1/3 or even half of the way to hitting that goal of around 200 grand. So this is a really good picture of long-term play. Look, we've really set ourselves up well here, and we are going to be able to build up that passive income stream. But now it's about how do we continue to build out that portfolio to get above that yellow line, essentially. So if you want to do it now, there's a few things you can do. So there's 5 ways, everyone gets stuck at this point, right? 2 to 3 properties, about $1 to $1.4 million worth of debt, everyone gets stuck. There's 5 things that you can do to continue investing. The first one is just simply find a way to increase your income. And it's easier than said than done. Everyone says find a way to increase your income. And I'm not talking about going to get a 5 or 10 grand pay rise. You can borrow about 6 times your income. So even if you're increasing your income by 10 grand, that's only 60 grand on the borrowing capacity. That's not going to be enough to go get a whole nother property, right? So we need to find a way to significantly increase your income. If that's not an option, we can potentially talk to a really investment savvy accountant / mortgage broker. And in combination, they can help us set up a separate entity that might allow us to get different types of lending to allow us to continue purchasing underneath that entity. Same thing goes for...
Georgie, sorry to cut you off, but even if there's no borrowing capacity left?
Potentially, depending how you distribute income, it's probably more focused for people who have businesses and have ability to distribute that income in a different way. Mm-hmm. That's a little bit easier, but there are definitely scenarios based on certain LVRs and the type of lending that you can get where even if you're just a pay-G income earner, you can actually potentially increase your borrowing capacity by buying in a separate entity. But that also goes hand in hand with a self-managed super fund or something like that as well. So obviously no financial advice. I'm not an accountant or a mortgage broker, but if you work with those two in unison to try and find out, is there another way that we can continue investing in some form of different entity? That's the best way to do it. Okay. Number 3, you can look at a lease stock loan. So what a lease stock loan is essentially buying an asset based on the rental income of the asset rather than your personal circumstance. So generally we see this more commonly in the commercial space where you can get, a 5 by 5 by 5 year lease. And generally the lenders will assess that asset individually and go, okay, well, it's actually covering all its costs. You're putting a higher, LVR or a higher deposit into the asset, and looking at all the numbers going out and coming in, it's going to cover itself, and we're happy to get you the lending on that asset to allow you to continue investing. And that option 3 is probably generally how we see most people continue to building their portfolio once they kind of get capped at this borrowing capacity level. Mm-hmm. So if we are going to do something, just given the borrowable equity that's available in the portfolio, we could look at doing something like that. Just to confirm, Alana, have you recently talked to a mortgage broker at all in terms of if you can extract equity or something?
No, I haven't.
Cool. Awesome. Well, as a first step, I'd definitely do that. And don't just speak to one broker. I don't know if you've had one broker in the past, but I would speak to 3 to 5 different brokers and just get all their opinions, and see where you potentially can get some lending, because that would be just to get a good grasp and understanding of what to do next. That would paint a really good story. Number 4 way you can continue investing is, let's say you go to the mortgage broker and they say you can't get any more lending. What you might be able to do is find someone in a joint venture situation. Now, this is a little bit more riskier than the rest of the scenarios, but essentially what you do with a joint venture is, say you've got the borrowable equity or the cash available and someone else has got the borrowing power or the lending ability, and you come together and you go and buy a deal together. Because you're both bringing something to the table. The downside of that, and what we commonly see is family members buying property together, maybe they're siblings and they buy when they're young, and then one of the siblings gets a partner, gets married, and all of a sudden they need some cash or they need to sell the property to buy their home or something like that. So when I say it's a little bit more riskier, it's generally because, the circumstance around that asset can change, and you're kind of you not have full ownership of that asset. There's other people who have opinions and decision making in terms of what you want to do with that. So it does give you the flexibility and an ability to continue investing, but it does come up with some more risks. Yeah. And the 5th way, just to wrap it all up, is potentially buying in a syndicate. Again, not as risky as option number 4, but it is still risky in terms of you don't have full control of the asset. But a syndicate is essentially a group of people who will come together to continue investing. And, it's less risky because they've all got a certain agenda together. They know that they're going to buy this asset for the next 5 years or 10 years and continue investing it doing that way. So a lot of people hit this wall. They think there's no way that they can continue investing, and I've just given you 5. So for people that are out there and kind of in this situation, there's definitely ways to continue investing. But if it was me and I was looking to go out and continue investing, I'd probably go down the trust/company structure first, see if there's any way I can get any other form of lending through there, particularly with the high equity or borrowable equity that you've got available in the portfolio. And then if there's nothing there, depending if you're happy with the circumstance you're in right now, if you're happy with the home that you're in, and maybe over the next 5 to 10 years you really can't foresee a change in your living circumstance, then we would go down that lease stock loan route where we can continue investing and have it all based off the lease of the asset rather than your personal income. Any sort of thoughts or high levels on those? Any of you two?
I was going to ask Alana a question, but I want to see, Alana, what with you sort of, is there anything that stands out there that you have any comment on, or what are your thoughts?
To me, the idea of commercial sounds preferable, I suppose you could say.
Yep.
But yeah, I don't really fully understand this thing about the business part.
Business and the trust structure?
Yeah.
What one thing as well, I think, Geordie, that I would add to this, because it's a question that I always ask people when they're stuck, because of one strong reason that a lot of people sort of want to do in their 20s and 30s, and that's the PPR, right? So you said, firstly, you're living there with a family member. Mm-hmm. Do they pay any contribution or not?
They help with bills.
They help with bills. Okay,
yep.
So we can't show... I'm not a mortgage broker, obviously not financial advice, but I know, speaking to enough mortgage brokers, what they're going to ask you, they're not paying any rent, so we can't show that. That's not a rental agreement. What are your thoughts on renting again, or renting?
I'm not against renting.
Okay, so you could potentially, this is why Geordie's shaking his head, he knows where I'm going with this one. Because what happens is, when you buy your PPR, it's really good because it's your own home and you can live there and you can stay there forever. The only issue with that is that it's not tax deductible debt, and you have no income. So that's what's pulling all of that down. So if you said to Geordie and us, and you say, look, I want to continue to buy a property. You've got for what I can see, you don't have to really forfeit a lot of your lifestyle because you have that large chunk of usable equity. It's just having the income to service it. So if we were to maybe run a scenario, George, I don't know, but could we potentially work out if Alana was to move out of that PPR, was to rent it out, have that debt being serviced, and then perhaps rent something that is a little bit more favourable? You could probably tell me what you can get for if it's an apartment or something like that. Are you a for or against apartments, or you want a house? Okay, so potentially if we were to move out, George, if it was Lana to move out with her family member, into an apartment, and we had that debt serviced by rent, is that going to look a little bit different?
Definitely. The good news is I put in a rougher 4% yield. Do you know what you could get as a rental yield for your current principal place residence, Alana?
Maybe, I don't know, 500 a week or something.
Yeah, 500 a week. We can have. Do you want to have a look? I can have a quick look.
I wouldn't know, to be honest.
Okay, we're going to do this. We're going to build this live.
I like it. So we're looking at Fraser Rise.
Yeah.
Three bedroom.
Rent.
Rough rent.
Fraser Rise. I should have probably went to, if anyone's looking for this data, you can also go to SQM Research, and you can put in the postcode, but sort, price, lowest to highest. There's 38 properties on the market. Townhouses. It's at 3 bed, 2 bath, 1 car?
2 car.
2 car? Okay. 322, 480 a week. These are a bit older. 480 a bit older. Okay, 500 a week seems pretty spot on. There's some 4-bedders and stuff in the 530s and 540s and 550s. Yeah, okay, George, let's run on 500. I reckon that's achievable. It's when did you finish the build?
Last year.
Last year, so it's pretty much new.
Yeah, it's new.
Confident with that. Yeah, let's put in a $500 a week rental income.
Nice, cool. So that's about 25 grand a year, and then based on the valuation of 750 grand, it's about a 3.3% rental yield. So we'll put that one in.
Wasn't it 600?
I think current value was 750.
Oh, current.
The build was 600.
Sorry, yeah. I'm talking purchase price was 600.
Yeah. Cool. So in terms of what that changes, obviously you've freed up with a lot of cash flow now. In terms of your passive income, we were negative 55 before. We're now only negative 30. So it's an extra 25 grand a year that you've got in your back pocket. Now the debt is tax deductible as well, so you do have that coming back at the end of tax time. And the cool thing is, over 30 years, you're actually getting quite close to, you're getting to 191 grand worth of passive income.
2 properties, that's it.
Yeah.
It's a pretty good outcome.
And even you've got 450 grand worth of equity. If you're putting that into a couple more, like this thing is going to, we'll be talking... You'll be doing your shopping. You have that $1 million.
Sounds good.
Definitely grow it a lot quicker.
Cool.
Okay.
So, in terms of the borrowing capacity as well, I mean, the banks won't, like that 25 grand is good, 6 times income. They don't factor in the whole thing. I think they only factor in, or depends on the bank and the lender, but generally they factor in about 80% of the rental income coming through. And then that does add to your borrowing capacity as well. So let's say, for argument's sake, you do have the ability now to go and you've talked to the mortgage broker. Mr. Broker said, we've freed up some space and we can go and now continue investing. We can do one more purchase or something like that. And that's probably another really good point as well, just to mention, like 18 months to 24 months ago, you could borrow about 7.5 times your income. We were in a really light economy. Interest rates were quite low. You know, a lot of people had flexibility to continue investing. Where in today's economy, you can only borrow about 5 times your income. So, you know, it really depends on the economy and market cycles that we go through. Like we might go through a season in the next 12 to 24 months where interest rates come down. And again, you have a big borrowing capacity. But if we can manage to find a way to get another type of investment, ideally, I mean, it's not going to be huge. It's not going to be $1 million property. But if you could go and buy another property again today, have you got any thoughts around what you'd go out and buy next?
I was only talking to my parents about this recently, and I said, is the best way to stay in residential or move to commercial? And I never really got an answer, and I never really decided. It was just sort of up in the air as to where to go.
What's the
perfect? That's my favorite question. Can I answer that question?
Yeah, go. Sorry, George.
So, no. I'm just going to butt in. I'm just going to take over the podcast. It's the best way to answer that question is the way you want to structure and build out your portfolio is make sure you got your principal place of residence debt covered first, which you've done. Like you're in your principal place of residence, and that might change over time. Maybe you do get married one day. Maybe you have a family. Like you might want to change where you live, but as long as you've got something allocated towards that, you're covered. Then you want to stick to residential until you're absolutely maxed out. You've deflated all avenues. You can't get lending in a trust. You can't do X, Y, and Z. It becomes really hard. And then once you've maxed out in the residential space, that's when we move to commercial, because you can get things like lease stock loans, where I was explaining before, that allows you to continue investing outside of the normal constraints of the lending environment. So go as hard as you can on residential first and then move to commercial. Now, if that means you can't get lending now, then it might be a good time to move to commercial. But if you can potentially still get more in residential, you want to do that first and then move over. The other thing that we obviously haven't talked about and discussed is that potential for a secondary source of income to be coming in. And when that does come in, given their individual circumstance, like they might be an investor as well and already maxed out, so it goes out the window. But if a secondary source of income does come in that hasn't been utilized, you're almost going to like double your borrowing capacity from where you are now, which means you can go harder in the residential space. And the reason we do it in those stages of resi first, commercial second, is because you don't want to go for commercial and then be maxed out in your residential portfolio, so you can't go backwards. Okay. So once you start to get more and more lending in the commercial space, obviously the banks will assess that holistically, and then they'll go, well, you can't actually buy another residential property, even though you might only have 2 resi and like 2 commercial. They're like, you can't buy any more resi because you're maxed out in terms of your overall LVR position and debt levels and everything else like that. So I would say, like, let's not just wait till a partner comes in and try and wait till we get the residential space. I think, you know, potentially moving into the commercial, if it's the only option that you can choose now, is a completely fine idea. And given kind of like where the income is on the portfolio itself, we're at like a negative 30 grand, even if we rent this one out and start renting ourselves, we want to make sure that rental cash flow level is going to be neutral at some point as well, because generally what we've seen and what I've learned over time is I've always been this like really growth focused person, and I think growth properties ultimately is what gets you wealthy over time. Like I still strongly agree with that statement. But the thing is, let's say you buy a really high growth property that, you know, for example, the one that you've got is going to be costing you 25 grand a year. Well, there's only so many of those you can hold, right? Like if you've got 2 of them, it's 50 grand a year. If you've got 3 of them, it's 75 grand a year. And all of a sudden that becomes unsustainable. So we want to be in a good, strong foundational properties in the residential space, but not too much that's going to put us out from a very bad cash flow position. And then, you know, balance the portfolio with those higher income commercial type assets coming through.
Cool.
Let me ask you a question, Alana. And it's not as easy. People like, in order to, I don't think, George, for the purpose of this, and Alana, you're welcome to correct me if I'm wrong, but the whole partner thing, if you're single now, I think obviously by the time you meet someone and by the time you decide you want to buy property with them, it's going to be a few years down the track, right? You're not going to just meet a person tomorrow. Yeah, bring them in. I'm ready to go. I've got so-and-so here, right? So let's take that out of the equation and say that's something that Alana can factor in 3-4 years time or whatever when she meets on and they're down that track. My next question would be, and it's delicate because your parents are your employer, and usually a good way to increase borrowing capacity is to increase the income. So have you thought about there being any opportunity there with your parents and, you know, what salary you earn at the moment? Is there any conversations that you think you can have? They might listen to this after, so it's going to, obviously, it's going to be a funny listen, but is there any opportunities there, do you think?
Not in the present, no.
Not in the short term?
No.
Okay. So I'm thinking first step would be, and we can connect you as well with a few really good brokers. Let's explore the trust path, Geordie, to see if that would be your first thing, to see if you can. If you can't and you want to keep moving, we would then need to look at commercial. So we may be
100%.
able to add in a commercial property. If you've got 400 and let's just call it, let's leave a bit of a buffer. And if you've got 400 grand in usable equity for a lease stock loan, you know, you can comfortably purchase, I would say, Geordie, you know, a $750,000 or a $700,000 commercial property using 35% of costs. That's 250 grand. So that's something that we can use. We can tap into the equity. We can use this. We're not leveraging you all the way up. We still leave a little bit of room within your portfolio and within your current properties. Gives you a bit of room to move. You make this purchase, and then, you know, once we have growth and that kind of stuff, we can tap back in for an extra 200,000 or something like that. Later down the track, maybe your income's increased, something like that. What are your thoughts, Geordie?
Yeah, I think that's spot on. I think let's try and go down, you know, potentially getting into one more resi if we can squeeze it in before we do transition into the commercial side of things. And so if you can squeeze in, I've put in a minimum of a 550K purchase here. I generally wouldn't buy anything under sort of that range. You kind of want to get into a decent asset if you potentially can. If you do talk to the mortgage broker and they say, look, we can only get you 400 or something like that, it might be worth just moving to the commercial space.
You know, that's interesting. Let's dig into that a little bit. Geordie, you don't think there's too much value in anything under 500?
Not necessarily. I think a lot of the regions over the last 3 to 4 years have increased to a certain level where you're still going to have to be priced out. So you probably still could find something really good at 400K. The problem is the geographical areas that allow you to buy a property at 400K are significantly decreasing as time goes on. And so, you know, the areas you could buy in, like a good example, somewhere like Bundaberg or somewhere regional over the last little while, where you could buy something good at 400-500, you know, 3 years ago. Now their values are 600-700 and they're becoming impossible to come in. So, you know, if you really do your research and you stick to something unique, like being coastal or something like that, but you know there's a really good, strong economy, you probably could still find something decent at 400. It's just that the collective group of areas that allow you to get into that price point are seriously diminishing over time. So, yeah, it's just about doing the due diligence around it.
I've got faith. You've
got faith?
Yeah, I've got faith that we can find a decent area for a $400,000 purchase for sure.
Okay.
Yeah.
Well, do you want to get in a 400?
Yeah, because I think 550, if Alana's borrowing capacity is capped out now, and even on a 20% deposit out of 550, you're still going to have a 450 loan, meaning you're going to need to have an increased income of, you know, 70 or 80,000. Just quick off the top of my head. Which, I mean, your parents might be great. It'd be nice to get that extra, but I don't know how lucky Alana will be in that sense. So if we go 400, We take a 20% deposit off that, 320 purchase. We do 320. Sorry, just doing it quickly off the top here. 320 divided by 5, there's 65K. But what I'm thinking is I'm not fully across the mortgage broking situation, so we can work with Alana and some mortgage brokers to see what's happening there. But yeah, I think it's 400 safer if we can fit one last one in, and then we can go into commercial.
Cool. I like it. And the other thing that I'll mention for Alana as well is for this next one, I think that diversification piece is really important, given you've already got 2 in Melbourne, and you mentioned all like the land tax things that have come up lately. I know like the tenancy laws in Victoria have become really tight lately as well. And just by being able to diversify into another place around the country allows you to be susceptible to different markets and different economies as they grow. A lot of people are talking about Melbourne looking to grow in the next little while as well, so it's not necessarily a bad thing that you've got 2 properties in Melbourne, but having that diversification piece allows you to take up different things that happen across the country at different times.
Yeah, I think you'll be in for a nice little surprise. I reckon Melbourne's due for it. I'll just say that.
Cool. So I put in the 400K purchase price. That would bring our total market value to just over 2 mil. So you're a double millionaire at 29, Alana, which is amazing. Debt levels at around 1.3. And then from a cash flow position, we're at negative 31. So I put in a 5.5% rental yield, which won't cover all of our costs, but it's not going to take us too much out of pocket. Okay. The cool thing about that is even if you just held on to those 3, in 2046, which is 24 years from where we are now, you'll be generating around 170 grand worth of passive income.
In how long? 20 years?
Yeah, 24 years from now.
Yep.
Which is like, that's a lot of people's dream to get into property, is setting them up into this position, and you're like one purchase away, which is awesome. But with the advent of a potential commercial coming in as well,
that's crazy. Can we talk about that? One more property purchase and you hit your goal. Obviously, it takes a little bit of time, but before retirement, you're hitting that. What's the passive income there, George?
166 grand.
Wow.
By 2046.
Okay.
Which is a scary number. You'll be 53, but like, you know, that's 10 years before like the average retirement. So you should be wrapped.
That's wild. Let's see if we can speed it up with some commercial.
Let's do it. So, I like the numbers you were throwing around before. So you reckon sort of 750?
Well, if Alana is using 20% deposit on a $400,000 purchase, let's call it 90, 100 grand all up. Yep. We take her. We say we're going to buy that property this year, and we might look into commercial next year or in 18 months. We've had a bit more growth in the portfolio, so I still think if it's a 700K commercial property, you can put 650 if you want to be conservative. You will still have the funds in equity to be able to fund that if we're assuming 35% on a lease stock loan.
Yep, I like it. So we'll go 650 just to be safe. If you can do more, that would be awesome. We're going to go interest only. We're going to take the funds out of equity as well. I'll bring the growth rate to, let's say, 5, just to be conservative with the commercial property.
Scotty O'Neill will probably bump that up, but we'll go conservative if he's listening. Sorry, Mr. Scott will go conservative at 5%. Yep.
A lot of people say commercial doesn't perform as well as residential, but it just can't happen, right? Like you can't have a block of land that's residentially zoned worth $1 million and then one commercial that's the same block of land, same size versus 500,000. Like it just doesn't make sense. But with commercial, the good thing is we can get something like a net yield and quite strong net yields. We're going to go for a 7% net yield here, which is quite average in the commercial space as well. So if we add that one to the portfolio, there's a cool couple of things that happen. Obviously, from a debt level perspective, we're pretty much lending all of it because we're extracting the borrowable equity from the portfolio. But we are now in a position where we've got a total market value in 2025 at 2.8 million. We still have 800K worth of equity and a total debt of around 2 million as well. So really strong, again, from an equity position, which you can thank mum and dad for like telling you to get in a property when you were 21, because like that's really set you up. So you should be stoked.
Yeah, and I think what's important to note is that a lot of people's first purchases are wrong, so it throws them back all those years. One, what you've done, you've got into the market really early, and two, your properties have grown and you've already generated that equity. So it's actually really exciting that the hardest thing is to come up with the money for the deposits. Now you've got that, and it's just the income, the structure, and the lending that we have to work around to get through. So this is wow, look at this. Okay, Jordy, talk to me.
Yeah, so from a passive income perspective now, in 2025, we're negative 36,000. So we were negative 31 before the commercial. This is still costing us around $5,000 out of pocket, because commercial loans generally do have a higher interest rate, plus we're lending all of it, right? So, but again, it's not so much that we're going to be like hemorrhaging out of pocket.
Jordy, what deposit did you put though?
I did 106% LVR, because we're going to be extracting the borrowable equity out of the portfolio.
Yeah,
right?
okay. Because I would argue,
like you could put cash in the deal, but I don't think we've got too much.
Yeah,
cash
we won't put
available.
cash. We'll use it from the portfolio, but obviously the 30% deposit we use for the commercial is borrowed from another loan. So instead of you putting 35 cash and you having a 7% interest rate on like 80% of your debt, it's basically 100% of your debt because we use that equity. 100%. So that's fair enough.
Yeah.
All right.
So the good news about that is we go neutral by 2029. Like our portfolio is paying for itself by 2029. There's no out of pockets. And then we actually now are hitting our goal of 160 grand worth of passive income in 2043. That's 19 years from where we are now, and that's 5 years earlier than by not doing this purchase. And I think this is a really good point. Like
shopping spree, pretty, it's
coming quicker.
Yeah. Okay, cool.
I think this is really important, because it's not like we're dramatically decreasing the time it's going to take to hit that passive income. It is 5 years, which is a long time, right? That we're bringing forward. But there's always this equilibrium within everyone's portfolio where obviously the more you continue buying, the more debt you're increasing your portfolio by. And so it's going to take longer to pay off that debt. Yes, there's a point where you can keep adding properties and you're going to build out a massive portfolio. But depending on your time horizon, you actually want to make the best decision you can for now. I mean, if we take this out to the 30 years, Alana's going to be generating $350K worth of passive income, which seems ridiculous. But if she was to continue adding her to her portfolio from here, it might actually push out her retirement passive income age, because we're adding more and more debt to the portfolio. But obviously it would equate to a much bigger passive income after 30 years or longer. So it's really for anyone about finding that balance of like, well, how quickly do we actually want to hit our passive income goals, and when do we need to stop?
Yeah, I totally agree, because I feel like people get carried away with numbers of properties and stuff like that. We've just proven it. Alana currently owns 2 properties. If she adds 2 more to her portfolio, one resi that she's buying for 400,000, one commercial that she's buying at, what did we put it in, George? 650?
650, yeah.
At 650, she could well and truly, you could retire before that, because that's $100,000 adjusted for inflation. So if you said you wanted 80,000, go back in the years, Jordy, and tell me when Alana's sort of hits 80,000.
Yeah, so we're hitting 82,000 in 2037. So 15 years from where we are now.
100%,
less.
And she's 28 now, so she's 28, 15. She's in her early 40s, and she's earning that sort of money. So what people, if you listen to this, don't get carried away on numbers and the flex of having this massive portfolio, because as Jordy has just said, you do have more debt and you retire with, obviously you have that bigger passive income, but it just means you have to leave more time, because you keep on buying and accumulating debt. You've got to wait for compound interest to do its thing, where it's like, Alana, 2 properties, is it the hardest thing in the world to do? Probably not. Set, forget, and this is where you can be. I think it's pretty crazy. What are your thoughts? Tell me.
That was a lot to take in.
Yeah?
Yeah. That was huge. But it sounds all really positive, I guess.
Sounds easy to do.
It doesn't sound overly hard.
Mm-hmm.
Yeah.
Okay. George, thoughts?
Oh, the good news is we've got it on recording, so you can go back and
Yeah.
rewatch this and
Thanks. I'm gonna
digest
need
it all.
it.
But the good thing is, like, a lot of people come to us and they think they need 10 properties in 10 months. Like, they think they need to build this ginormous portfolio to be able to retire early. It's going to take them forever. But we've realized that most people can achieve their goals in 3 to 5 properties. And this is a really good scenario of that. Like, you're doing it within 4. And so the good news is, like, you started 10 years ago, and that 10 years has brought you forward to this position now where really you're only doing 1 or 2 more transactions over the next couple of years. You're letting time do its thing, and then you're ultimately hitting your goal. Depending on how high you want your goal to be, you could be looking to retire in the next 13 years. If you want to wait 20 years, then you've got more passive income coming through. But by setting yourself up nice and early, you've bought your time back in your 40s. You're actually going to be able to hit your goal in your 40s, which is crazy. Like, I bet you there's 40-year-olds listening to this now, like, just starting and wishing they started when you did. So I know it seems like a lot to consume, but you're actually on a really good trajectory.
Thank you.
Yeah, and I think even at 5 years, when your portfolio, if this was the case and what you did, when it starts to become positive, like, that only needs to be positive, 20, 30, 40 grand a year. And, there's your couple of holidays every year, paid for by a property. And that you're still getting to, this, you're still getting to the end point. Like, work and that is covered, and you've got this stream coming in. So it's like, this is actually really exciting. I'm excited for you for this. So, Geordie, what do you think? Let's sort of summarize this. Let's have some actionable items, and let's see if we can package this up for Alana, that if she wants to keep going down this path, we can give her some people to talk to, and we can we can follow her along for the journey. Podcast, we'll book her in for 2025, and we'll reconvene.
She might come back and say she wants 2 million now. So
more shopping.
But to package it up all, we got 2 moves that we're doing next. The best thing that we can do is talk to a number of really good investment savvy mortgage brokers / accountants to potentially look at getting some additional lending in our own personal name, or move to a company / trust structure if we have to be able to continue investing. We're then looking for a minimum sort of 400K purchase, minimum 6.8% growth rate, which is the Australian average, but we want to be on the Australian average, if not better. And we're looking for a minimum of a 5.5% yield. So you can take just those pure 3 numbers and metrics and filter out all of the suburbs or areas across Australia that will allow you to buy that type of asset in those locations. Then you've done your location selection and continue to do your purchasing down from there.
Geez, I wonder where I could find an episode of how I could filter through properties like that. Yeah, I don't know.
I reckon you could do one. There's some good platforms out there that'll allow you to do it.
Perfect. Yep.
Purchase number 2, potentially wanting to do this in 2025. We want to execute on these purchases as soon as possible. Best thing to describe that is, like, you want that growth and the increase in rent and all the good stuff that comes with property in your name, rather than you having to pay someone else for it in another 2 years or 3 years or 4 years. So we want to execute on these things as soon as possible. But purchase number 2 comes down to a commercial asset. We're looking for a minimum of a 650K purchase price. We want to be extracting equity in our existing portfolio to be able to do that. We're looking for a minimum compound growth rate of 5%, which is really low for commercial type assets, but hey, we're going to do what we can. And then we're looking for a minimum net yield of 7%. If we go on to acquire those 2 assets, we're looking at a total debt level overall in the portfolio at 2 million. Most people have this, like, uncomfortable level at sort of $2 to $3 million worth of debt where they feel like it's too much. So we're at the lower range of that, which is really good. We've got a total market value of 2.8 million. We are at a negative cash flow position of around 36 grand, but the good news is that's the worst that it's ever going to be, and that's at some really high interest rates as well. So hopefully, if interest rates come down over the next little while, you'll be in a much better cash flow position. We're then looking to continue working for the next 5 to 6 years, get that portfolio in a positive cash flow position, and then it's kind of smooth sailing, depending on how much income you want. If it's the next 15 years, we'll be at that sort of 80K range. If it's 19 years, that's when we actually hit that passive income goal of 161 grand.
Cool.
Easy.
Sounds it.
Jordy, just quickly, 2 questions I have from this. What's the interest rate that you've used for these calculations?
So for the resi, we used a 6% interest rate, and the commercial, we usually use a percentage point higher, so it would be at 7%.
Can we, I am going to forecast, I mean, let's play around a bit. I don't think 6% will be the average interest rate for the entire rest of this, though. It's great that it works at 6%, but I foresee that not being an average. Can we do an average of, say, 4.5% interest rate?
Yep, definitely can. So if we go custom interest rate at 4.5, and for commercial, did you want to maybe do like 5.5, like still a percentage point above that? And
can we also we'll bump that commercial growth rate to 6%.
Cool.
Yep.
Let's rock and roll.
Show me what that does, please.
Cool. So good news is neutral is still same time horizon. So it's still going to take a couple years. The good thing is, like, we have enough cash flow coming through now that we're actually able to pay off. Like, this big jump in our cash flow means that we're actually paying off some of those original P&I loans that you're still holding on to. So those first 2 properties, 1 or 2 of them might be on P&I, but you actually pay one of them off completely in 2041. And that's 17 years from now. And you've got a passive income of 175 grand. And then you pay the second P&I loan off in 2045. We've got 250 grand worth of passive income coming through. So, you know, that's $250,000 coming through debt free in 2045, which is like 21 years from where you are now.
That's a lot.
Yeah. I mean, there's not going to be any job that you can do, or like, that's why I love property so much. It's like, where else can you get that return passively in 4 assets? Like, it's wild.
It's pretty crazy.
Jordy, just quickly, sorry to cut you off. If we zoom in on what I'm seeing in your graph and your tables, is that in 2024 we look to be what's our cash flow there?
That's negative 51, so that's factoring in still having the principal place of residence where we are now.
And then we go to year 2?
Yep, so we're at 21,000. Wow. Where before, I think we're at 36,000.
Wow. This is
big change and big difference in the interest. And remember, for those 2 purchases, we both did 106% LVRs, so we were like lending as much as possible. That's why there's such a significant drop.
Yeah, so if you had any cash that you wanted to put down as a deposit, you didn't have to, but if you did, it'd just make everything all a lot better because you've had that less there. Mm-hmm. So, yeah, if you put like, if you had 10% of that $400,000 purchase in cash, it'd make a huge difference as well. So, Jordy, this is really exciting. I really appreciate it. Alana, thank you so much. Do you have anything else, any other questions for Jordy regarding this before we close out?
Nothing that comes to mind, no. Thank you for doing all of that.
Cracker.
It's all good.
It's a lot.
Hope you've found some value in it.
Yeah, it was great.
Yeah, I know it's a lot to take in all at once, but the good news is you got access to the platform moving forward, so you can jump in at any time and revisit some of the numbers and statistics.
Yeah, awesome.
Nice. I think what we do, we'll package this up. Alana, we can give you a little set of things to do, people to contact, action it whenever you want to thingo. And hopefully we can do a little check-in podcast in 6-12 months time. And if you've got another purchase or anything like that. And
sounds good.
Yeah, it'd be really exciting. One thing I actually end on, Jordy, I'm going to ask you too, but I always ask people, what is a quote they live their life by?
Give
me.
I am a big fan of everything happens for a reason.
I like it. There you go. Okay, well, you're here and this has happened. So, Jordy, what about you?
Oh, I did one that last one. I can't remember what it was, but I was like, a dream written down with a date becomes a goal.
No, don't give me
A
the
gold
same
rookie.
quote. Give me a new one.
A new one. I don't know. I don't know what I live by. Life's good. That's my quote. Life is bloody good.
Says that I can see the pool in the water over Geordie's right shoulder. He's probably gonna jump off his deck into the pool or something like that. Look, Geordie, appreciate you coming on, joining us from sunny Gold Coast. Alana, appreciate you as well, spending time out of your busy week. You've got some good bosses that have let you come up to do this. So really looking forward to where this may be able to take you.
Yeah, thank you both for having me. It's been really good.
Too easy. All right, thanks George.
Guys.
Thanks.